Good morning. Good morning, everyone. It's a great crowd here today. Thank you so much for attending, and I know you will not be disappointed and will have found tremendous value in this presentation. Dr. Joseph Stiglitz is a Nobel Prize-winning economist and will be introduced more formally in a minute. I'm Sherry Cooper, and I am the TMX Industry Professor at McMaster at DeGroote School of Business, and it's a great pleasure to be here today to welcome you all to the Horizons ETF Insight Conference. I have been spending this past academic year and chairing a monthly series of finance presentations at the National Club. We will begin that again in September, and you are all cordially welcome to attend. What we are doing at DeGroote is we are integrating and introducing the academic faculty of the Business School of McMaster to Bay Street and Bay Street to DeGroote. It's a very interesting phenomenon for me, having been an economist in what we call the real world rather than the academic world. Much of the research that is being done in the academic world does have direct applicability to the jobs that we all do, but without that conversation and communication between the two groups, the enrichment of taking the real business community into the research and vice versa is missing. So that's the idea of events such as this. I'm very happy that you could all be here, and now I'd like to turn the podium over to the Dean of the DeGroote Business School, Dr. Leonard Waverman.
Well, it's a great pleasure to be here and to see you all, if I can see you all. As Sherry said, the mission of DeGroote is to do what McMaster does so well, especially in medicine, which is evidence-based scholarship. And that is our mantra, is that we bring evidence to bear on business problems and bring you speakers who provide the evidence, the facts, whatever they may be. I'd like to thank first Adam Fileski. Adam, where are you? Here, Adam. So Adam is a graduate of McMaster, founder of Horizon ETF, and is one of our great supporters. We thank you for your support, Adam. And I want to thank Kelly Anderson and our whole team at DeGroote and the team at the Horizon who have put this together. Thanks for working so hard, folks. Adam will be introducing Joseph in a moment. I also want to recognize Dave Lazzarato, the chairman of the Board of Governors of McMaster. David, where are you? So I'm not going to really introduce Joe, but I want to just say something personal about him. I first met Joseph in graduate school, where he was 2 years ahead of me and 1 year younger. And that was, I guess, the fast track to the Nobel Prize. Second, Joseph's writings are very moving to me, especially his column in the New York Times. And for an economist to have that effect on someone is unusual. We are not the dismal science for nothing. I just want to read to you briefly from a column he wrote in the New York Times on August the 28th of 2013, the 50th anniversary of the march, and the March on Washington for Jobs and Freedom. And this is from his column. I had the good fortune to be in the crowd in Washington when the Reverend Dr. Martin Luther King gave his thrilling "I Have a Dream" speech. On August 28, 1963, I was 20 years old and had just finished college. It was just a couple of weeks before I began my graduate studies in economics at MIT. As president of the student council at Amherst College, I had led a group of classmates down south to help push for racial integration. We couldn't understand the violence of those who wanted to preserve the old system of segregation. But now, like so many looking back over the past 50 years, I cannot but be struck by the gap between our aspirations then and what we have accomplished. The battle against outright discrimination is regrettably far from over. 50 years after the march and 45 years after the passage of the Fair Housing Act. The raw numbers tell much of the story. This is the evidence. Is the U.S. really upwardly mobile, or is that just a figment of imagination? He didn't say that. There has been no significant closing of the gap between the income of African Americans or Hispanics and white Americans the last 30 years. In 2011, the median income of black families was $40,495, just 58% of the median income of white families. Turning from income to wealth, we see gaping inequality too. By 2009, the median wealth of whites was 20 times that of blacks. The Great Recession of 2007-2009 was particularly hard on African Americans. They saw their median wealth fall by 53% between 2005 and 2009. But the so-called recovery has been little more than a chimera, with more than 100% of the gains going to the top 1%, a group where, needless to say, African Americans cannot be found in large numbers. I turned 70 earlier this year. Much of my scholarship and public service in recent decades, service at the Council of Economic Advisors, then at the World Bank, has been devoted to the reduction of poverty and inequality. I hope I've lived up to the call Dr. King issued a half-century ago. Joseph, you have lived up to the call. We thank you for that. Adam.
Thank you, Len, Dean Waverman, Dr. Cooper. Looking out this morning at 7:30 and seeing you all here, a Nobel Peace Prize professor is quite an accomplishment, but in Toronto, getting this many people out to a breakfast may be your greatest achievement yet. We at Horizon have been trying to do these things for years. 6:30, maybe, p.m. We at Horizons are extremely proud to be sponsoring the third annual Horizons ETF Insight Lecture, with each growing in number of people as witnessed today, as well as the caliber of speaker. Through this event, our goal is obviously to raise the profile of the school, but at the same time, provide important thought leadership to business leaders like yourselves to help us navigate through what is becoming a more challenging market environment, as well as a political one. Professor Joseph Stiglitz from Columbia University is named as one of the 100 most influential people in the world, recognized globally as a leading economic educator, and 2001 recipient of the Nobel Prize in Economics for his analysis of markets with asymmetric information. He was chief economist and senior vice president of the World Bank, as well as lead author of the 1995 report of Intergovernmental Panel on Climate Change, which also shared the 2007 Nobel Peace Prize. Professor Stiglitz speaks around the world on the challenges of the global economy, monetary policy, financial instability, and inequality. This morning's very early talk is entitled The Great Malaise, Explaining America's Slow Recovery. Please provide a warm welcome for Professor Stiglitz.
Well, it's a real pleasure to be here, and thank you all for showing up so early, and I hope you feel it's worth it at the end. So what I'm going to talk about today is a puzzle, and try to explain the puzzle. The puzzle it's been more than 5 years, going on 6 years, since the Lehman Brothers collapse, the beginning of the recession, and we're out of the recession. Officially, as the numbers that were just mentioned indicate, at least in the United States, most Americans don't know that we're out of the recession. That is to say, the way we define a recession is 2 quarters of negative growth, and we started growing in terms of GDP back in 2009. But since then, about 95% of the increase of the income have gone to the top 1%. And that means for the 99%, there's been basically no increase in income. I'll show you a little data in a few minutes. Things on the other side of the Atlantic are even worse. Again, I'll show you some data in a few minutes pointing out that almost all the countries except Germany have a lower income per capita, income relative to their working population than they did before the crisis. And the one successful country, so-called successful, is Germany, and its growth rate has been around 1%. And normally we would say somebody who's grown for 1% for 6 years is a failure. And if you look more closely at what's happened in Germany, the bottom third has seen their income go down. So we're, in a way, at a particular moment in market economies that in the West, in the advanced countries, our economies have not been delivering for very large fractions of our population. And so we have to ask the question, what has gone wrong? So the real theme I want to try to do is provide some glimmers of an answer to that question. But first, I want to spend a few minutes just describing where we are, and to rephrase what Len said. So, what are some of the evidence about what has been going on? So, this just highlights that the crisis that began in 2008 has been the deepest economic downturn since the Great Depression, the longest, and I think the end is not in sight. Even though things are better than they were, that's sort of a low benchmark. They were really bad. You feel relieved that we aren't in a hole that keeps going down. I know this is really terrible to start the morning with this kind of, but Len warned you that this is a dismal science, and so I'm going to really give you a dose of dismal, so you can, the rest of the day you can feel good. The one way to think about where we are is in the middle of the Great Depression, say around 1936, the Great Depression started officially sort of with a stock market crash in 1929. No one really knew how long it would last. And if you remember, no, you wouldn't remember, but, but if you remember reading about this, in 1937, America went into a double dip, and we went back into recession, and we really didn't get out of the Great Depression until World War II. And had there not been for World War II, I don't think we really know how long the Great Depression might have lasted. And that story that it was World War II really carries an important message. We got out of the Great Depression because of government spending. it would not have happened on its own, or at least it would not have happened quickly. I mean, it wasn't quickly. It would not have happened even as quickly as it did, more than a decade, had it not been for government spending. Obviously, we had no choice. The war eliminated all those controversies about whether we should have austerity or not. There was no option. But we should be clear that it was government spending that got us out of the Great Depression. And had we been able to have that government spending on things like roads, education, technology, our economy would have been even stronger. But we didn't have that choice. We had to spend it on guns, on things that protected us, but didn't build a stronger economy. So the moral of this particular story is that economies do not necessarily recover from their own, from these deep downturns. There is a role for government. And it's going to be policies that governments undertake that will determine how long we remain mired in this sort of dismal state. And if we change our policies, we can recover more quickly. If we don't, it is very likely that things could continue on the current trajectory. So let me begin by talking about the U.S., and I'm going to talk mostly about the U.S. There's a lot of celebration that we've started to grow, and that's true, but the growth is still anemic. It's still barely enough to create the new jobs, new jobs for the new entrants in the labor force. So we're making very slow progress in bringing down the 20 million Americans who are unemployed or who would like a full-time job and can't get one. One of the ways to think about this is if you adjusted the unemployment rate for the fact that a lot of people have dropped out of the labor force, that our unemployment, rather than being around 6.5%, would be much more like 10 or 11%. Remember, the way we talk about unemployment is we ask somebody, are you actively looking for a job? And if they say no, we treat them as not unemployed. But of course, they're not employed. And we have literally millions and millions who've just given up looking for a job because they've looked for years and years and haven't found it. And after a while, you get discouraged. So the real state of the labor market in the United States is very bad. And it's reflected in the low wages. And that means incomes are not doing very well. And just to give you a couple of statistics that show how bad incomes are doing, median income, that's half the people above, half the people below, median income in the United States is lower than it was basically 25 years ago. So you can imagine, in the middle and the bottom, more than half Americans have had stagnant income for a quarter century. What is going on, of course, when I use that number, it's worse in some demographic groups, some parts of the country than others, and better in some parts. One demographic group that is obviously important, looking around this audience, I see it's particularly important in here, which is males. Maybe overrepresented. But among that important demographic group, median income is lower than it was 40 years ago. So if you want to understand why there are a lot of angry men in the United States, the reason is that as they look around, they thought they were going to do better than their parents. They're doing worse. In fact, some of them are doing worse than their grandparents. So here is just some graphs that show what's been happening. So this is U.S. median household income since 1975, and basically adjusted for inflation. All these numbers are adjusted for inflation. And what you see is that actually since 1980, things have went up very slowly, but then since 1989, they've been on a downward trend. And this is for a full-time male worker. And you see the stagnation has been going on for even much longer than that. By the way, productivity has continued to go up, but the workers have not shared in the productivity gains that have occurred. And here is the graph showing the labor force participation, the fraction of Americans that are actively of the working age population that are actively in the labor force. And what you see is it plummeting. Part of this has to do with the aging of the population. I'll explain that in a second. But even if you look at 20-year-olds, 30-year-olds, the labor force participation has plummeted. Now, you will often hear from people in the administration, the Federal Reserve, and say, well, some of this has to do with the fact that 50-year-olds and people in the 60s always had a lower labor force participation. And therefore, as the baby boomers age, you're going to see, it was anticipated we would see some decline, not this much. But what I want to emphasize is that's not really a very good answer, because the reason the labor force participation for the most part declines in the 50s and 60s is not because people don't want to work. It's because we in the United States and some other countries are not very good at retraining workers. So as their skills become a little bit obsolete, we say thank you for working for us for 30 years, and then we throw them in the garbage dump. And what was a little problem when that fraction of the labor force was a small part of the population is now a big problem. So the fact that we have a large number of people in their 50s and 60s who have been thrown in the garbage dump, who want to work but don't have the skills or are not being integrated in the labor force, I view as a major problem. And so the answer is, well, it's just aging. The change in demography is not very convincing. What is striking about this weak performance in the United States is that it occurs in spite of the fact that there are some very strong things going on in the American economy, in American society. And you read about those all the time, things like discovery of shale gas. We brought down the price of gas, helped manufacturing, a little bit of resurgence of manufacturing, but very little. The high-tech sector is a very strong sector. But one of the things about these sectors that are doing very well is they're not very good in job creation. So take one of the real success stories in the United States, Apple. The market capitalization of Apple at one point was greater than GM at its peak. But Apple in the United States had only something like 49,000 workers, of which 30,000 were low paid, when I say low paid, very low paid, retail workers. And so there were only 19,000 of what you would call good middle class jobs. So the point is that even the successful part of the U.S. economy is not really creating jobs. Well, the persistent high unemployment in the United States almost inevitably is going to means that our future prospects are actually being diminished. An interesting study by the Fed pointing out that because we have so many people in long-term unemployment and youth unemployment is even high, is about twice the average rate, the result of this is that people are not building up skills when they ought to be, and our potential growth rate is coming down. And the Fed estimates that the economic weakness following the Great Recession has reduced U.S. potential growth by some 7%. And particularly troublesome is, for the first time, the United States has developed a problem of long-term unemployment. We also used to think of this as a problem of Europe, not a problem in America. We have, even our unemployment insurance scheme was always focused to the fact that we were short-term unemployed. We only covered people for 26 weeks. Now, I don't know if you've been following, in the United States, in the aftermath of the Great Recession, we extended the unemployment benefits, but now those extended benefits have been terminated, and millions of Americans will be without any safety net. That is to say, there's no unemployment insurance, and we have no welfare program. So they will be left to fend for themselves in a really very cruel way. So one way of seeing where we are is to look at the extent to which the U.S. is below trend. Growth in the United States in the 35 years, third of a century, beginning in 1980, was much lower than it was in the decades after World War II. We should remember that the period of deregulation, the period in which we let market forces dominate, had much lower growth than we did after World War II. And it was a period in which inequality grew. The benefits of that limited growth went all to the top. You saw the graph about what was happening to the median. Whereas in the period, the decades after World War II, every group in our society shared, but those at the bottom grew more than those at the top, but every group grew. So there's a marked difference. But even looking at that very moderate rate of growth that we have since 1980, what you see is that beginning in 2008, we went below the trend line, and the gap between where we would have been and where we are today has been increasing. There's no real closing of the gap. And so right now, we're something like 15% below where we would have been. So every year, our GDP is 15% below what it would have been. That's a little bit over $2 trillion a year that we've lost because of the recession. And of course, year after year, that adds up. As Senator Dirksen used to say, a billion here and a billion there, and pretty soon you're talking real money. Well, now we say $1 trillion here and $1 trillion there, and pretty soon you're talking about real money. Now, the only thing that makes America feel good is it could be worse. I don't know, there's Schadenfreude. And on the other side of the Atlantic, it is worse. So I don't want to spend a lot of time here talking about how bad things are in Europe, but just to mention a couple things. There are certain words that you're not supposed to use in polite company, and one of them is the word depression, because to use the word depression is depressing. But large parts of Europe are in depression. And just to give you a flavor of how bad things are, the average unemployment rate in Europe is around 12%. But if you look at the youth unemployment rate, the average youth unemployment rate is 25%. But that average is obviously an average between the better performing economies and the worst performing economies. In a country like Spain, the youth unemployment rate is over 50%. In Greece, it's over 60%. And it's been that way since 2008, 2009. So if you can try to imagine what it means for half the young people not to be able to get a job year after year, what it's doing to the society. And these numbers are numbers after immigration. So what you see, if you talk to families in Spain, in Portugal, in Greece, all those who can are leaving. And it's tearing apart families. And it really, I described before how the unemployment in the United States is lowering our potential growth going forward. Well, if that's true in the United States, you can imagine what this is doing to the future of Europe, future of countries like Spain, like Portugal. So right now, there's a little bit of a note of optimism. They say, we started to grow. Well, yes, that's better than decline. But the numbers are so weak that no one thinks that they are going to be back to where they were, let alone where they would have been anytime soon. You're talking about the next decade. And just to show you a few numbers, here is looking at GDP per capita adjusted for constant dollars. What you see is that almost all the countries have a lower income today than they did before the crisis. And the only exception to that on this chart is Germany. And as I said before, even Germany, the rate of growth is so slow that in any other context it would be called dismal, and a large fraction of the population are actually having their income go down. And this is a chart that shows GDP per working age population, which really reflects in a way what's going on in the economy. And what you see here is the only two countries in which GDP per working age population has recovered from what it was before the crisis are Germany and the United States. Canada's not on here, so these are major countries. No, I didn't mean that. No, because there are many countries much smaller than Canada on this graph, and it shows them partly to be dramatic. But you can see there, Greece has had a decline in income adjusted for inflation by 25%. Those are numbers greater than, much worse than the Great Depression. And you see Italy, Ireland, Portugal, France, all with very significant declines. And this is, as I say, 5, 6, 7 years after the peak. So this is why this really is a field day for anybody who wants to be dismal. So what is the problem? I don't want to spend a lot of time on the problem in Europe. I think it's a combination of the flawed structure of the Eurozone, not the structural problems within the individual countries, but the design of the euro itself. The euro, Europe has a lot of strengths, and it was actually doing quite well before the crisis. I think, as I say, it has a lot of strengths. But it shows one mistake can have very big consequence. And what was that one mistake? The euro. They decided to have a common currency, and they weren't really a group of countries that could share a currency easily, and they didn't make the kind of institutional design that, given the problems of making it work, would enable it to work. So it's a fundamental problem, and a lot of us were hopeful that in 2010, when the problems came to the fore, they would say, okay, we need to finish the job that we started a decade earlier. We hadn't gotten it right. Let's fix it. And instead, they combined a flawed structure then with very badly flawed policies. And the result of it has been the crisis that has continued since then. Well, there is among economists a clear understanding of what is needed, abandoning the strategy of austerity, having the structural reforms, which include a banking union, mutualization of debt, revision of the ECB mandate. But what I want to go on is to the main thrust of this talk, is to try to explain why there has been such a lackluster recovery. You know, most of the economic downturns that we've had in the post-war era, the economy's gone down and then bounced up again. And we had a deep downturn in 1980, and then we had a big bounce back. And some people were expecting that this time. It hasn't happened. Well, one way of thinking about what happened in 2008 as the policymakers contemplated what to do, they had a particular model in mind. The view was that the financial sector had behaved badly. We had a bubble. The bubble broke. The banking system was very weak. We had to fix the banking system. So the basic idea was a very simple one. The banking system had to go into the emergency room in the hospital, and we would give it a blood infusion. What we mean by blood is giving a few $1 trillion. That would make it feel better and help it recover. It would take a year and a half or so to get it back working. Once it got back working, then the economy would go back to where we were. And in the meanwhile, we needed a stimulus. Don't worry too much about the details of the stimulus because the economy will be recovered in a year and a half. So just, figure out what you need to do to put it back to in this period when the financial system is not up to par because of the trauma which it suffered. Well, the banking system is not fully back to fully functioning, exemplified by the fact that SME lending is still about 20% below what it was before the crisis. But basically, the financial system is making huge profits. It's not really on the ropes anymore. It's actually doing quite well. And yet, the economy has not recovered. So that suggests that diagnosis that we had in 2008, or at least like some people had in 2008, was wrong. And in my mind, one of the fundamental mistakes was that they didn't fully appreciate that in 2008 and 2007, before the crisis, the economy was in a fundamental sense sick. What do I mean by sick? Well, you say, well, growth seemed to be good. Unemployment seemed to be low. What do I mean by being sick? Well, what I mean is that what kept the U.S. economy going was something that was artificial, namely a bubble. If it hadn't been for the bubble, the U.S. economy would have been weak. And that means that we can't go back to 2007, at least we shouldn't go back to 2007, because going back to 2007 would have necessitated creating another bubble. And we know about that. We had the tech bubble, we had the housing bubble. We don't want to have another bubble. I mean, the Fed is trying to create another one. And it's done a mild job of creating another one, but still, it's not the basis of sustained, robust growth. So what I want to do is spend a few minutes trying to explain why I think it was that the economy in 2007 wasn't really healthy. What are some of the more longer run problems that we've been facing? And it'll be pretty clear from my diagnosis, from my analysis of what we ought to be doing. Unfortunately, many of the problems that I'm going to talk about have gotten worse since 2008. So rather than remedying the situation, we've made things in some ways worse. So as I look around the global economy, I look at this from a very global point of view, but it also is true about America. The fundamental problem facing the global economy is a lack of aggregate demand. And that lack of demand means that without any demand for goods, there's not going to be jobs, and it's a vicious circle. Without jobs, there's a lack of demand, and what we call an underemployment equilibrium. And there are 5 problems that I've listed there global imbalances, need for structural transformation, growing inequality, dysfunctional financial system, and austerity. I'll go through each of these very quickly. The bottom line that I want to emphasize, though, is that in a fundamental way, markets aren't working the way they're supposed to. Because if we look around the world, what we see is vast underutilization of resources. Underutilization of labor, but actually also capital, machines, that are not being fully utilized. But we also have huge unmet needs. We have, huge needs for infrastructure, huge needs for retrofitting the global economy to address problems of global warming. You can make a list of things that we really need. And the fact that we have people that want to work, resources that need to be utilized, and that we have unmet needs says something is not working right in the global economy. It would go beyond this talk for me to say exactly why things aren't working as well as they should. But what I'm going to try to talk about now will highlight at least some of the problems. The first is global imbalances. What we mean by global imbalances is that some countries have large trade surpluses and some countries have large trade deficits. The sum of the surplus is equal to the sum of the deficits. That's a basic identity in economics. But and the nature of any economic relation, it's nothing inherently wrong about global imbalances. Before the crisis, there was a lot of worry about what was called the disorderly unwinding of these global imbalances. But now we understand that there's actually another fundamental problem with global imbalances, and that is the deficit countries have to cut back their spending. They can't spend. But the surplus countries don't have to increase their spending. So there's an asymmetric response. People who see their income going down, if they can't borrow, have to cut back their spending. People whose income go up don't have to spend. And when you have a divergence like that, you get a weakness in overall global aggregate demand. And some of these imbalances, again, have gotten worse since the crisis. For instance, before 2008, U.S. was constantly bashing on China about its surpluses. China was selling all these goods but wasn't buying goods. And that was weakening the global economy. Actually, the surpluses today of Germany and Northern Europe, in absolute dollar terms and as a percentage of GDP, are much worse than that of China. And so we have, a problem of surpluses not only in Asia, but also now in Northern Europe. And that is diminishing overall demand. The problem wouldn't be so bad if we had a financial system that took these surpluses, the financial surpluses, and figured out how to spend them well, i.e. lent them to one of the needs I described before that would for investment that would increase global aggregate demand. But even before the crisis, it didn't do a very good job. Where were we spending money of the sum of the surpluses globally? We were spending it building shoddy homes in the middle of the Nevada desert. Does anybody really think that that was the best use of the world's scarce savings? Answer is obviously not. There was something wrong. That it was a problem was widely recognized. Ben Bernanke talked about the savings glut. And as I looked, as I heard when he talked about it, it always got me actually very annoyed because it wasn't as if the world had too much savings. We had real need for investment. The problem was that our financial system wasn't able to take that savings and redeploy it to where it could profitably be used. It was taking that savings and misallocating it to places where the returns were actually negative. So that's one problem. The second problem is the problem of structural transformation. Economies are always going through a period of change, but this is a period of, you might say, very intense change, going from manufacturing economy to a service sector economy. Let me try to explain what the fundamental problem was. It's a little bit analogous to what happened almost a century ago. We're a victim of our own success. 100 years ago, a little more than 100 years ago, about 70% of all workers worked in agriculture. They had to work in agriculture to produce the food that we needed to survive. But then, as a result of research, mainly sponsored by U.S. government and other governments, agricultural productivity increased. And that meant you needed fewer and fewer people to produce the food that you needed. To the point today in the United States and Canada, about 3% of the population produces more food than even an obese population can consume. And so we're major exporters. Well, you can say that's a big success, but it's also a problem because that huge body of people who worked in agriculture have to move to go to something else. And that movement is often not smooth. People who had assets, skills relevant to one world have to move in another, and they don't usually have the ability to make that transition without help. So what is the comparable thing going on today? Well, the comparable thing today is we've had real productivity increases in manufacturing. Productivity increases exceeding increase in demand. And what does that mean? If productivity increases faster than demand, that means employment is going to go down. Employment in manufacturing globally is going down, but there's now, for the United States and Europe, of advanced countries in general, there's an additional problem. Our comparative advantage has shifted. Comparative advantage has shifted to Asia for at least, and to emerging markets for a large fraction of these manufactured goods, not for all, but for a large fraction. And so the advanced countries are getting a diminishing share of a diminishing amount, and that means manufacturing employment is going to go down, and that means it has to be redeployed. But as I say, markets don't do this very well. Now, as I said, where they're going to be redeployed, well, it's almost definitional. They're going to be redeployed to service sector. Nothing wrong with that. And service sector are things that we really care about. Among the things that we really care about are education and health. There are also cultural services, lots of things in the services. But two of the key services are education and health. And those two sectors, for very good reason, are very naturally associated with public support. In Canada, you have a public health system, you have public education, public universities. Unfortunately, in most of the advanced countries, there's a cutback in the public sector. So at a time where we ought to be expanding education and health, we're actually cutting back the public sector. And so this has made the transition from the old economy into the new economy all the more difficult. So that's the second problem that has gotten worse as a result of the recession. The third problem is growing inequality. Inequality, and that's the subject of my book, The Price of Inequality. Inequality is a moral issue, but it's also an economic issue. And there are many dimensions to this, but I only wanted to talk about one here. Why is inequality related to this weak economy? Well, those at the bottom typically consume a larger fraction of the income than those at the top. In fact, those at the bottom consume virtually everything. When I say the bottom 80%, we're not talking about the bottom 5%. The bottom 80% consume about all their income. And the top saves about 15-20% of their income. So if you redistribute income from the bottom to the top, total savings, total consumption goes down, and that leads to weak aggregate demand, unless something else fills in the gap. So we had growing inequality in the United States, particularly as you saw in the graphs beginning around 1980. And then in the beginning of the decade, around 2000, 2001, 2002, how did we fill the gap? Well, we filled the gap. The economy would have been weak had it not been for what the Fed did. What did the Fed do? It created a housing bubble. So the housing bubble worked in the sense that it led people to consume more. They felt wealthier. In fact, the bottom 80% of Americans were consuming 110% of their income. And that solved the inequality problem, sort of. But it should have been obvious that you can't, the bubble was not sustainable. One of my predecessors as chairman of the Council of Economic Advisors once said that that which is unsustainable won't be sustained. So this was not sustained, and it left a legacy of high indebtedness, overhang of housing, so it left a whole set of problems in its aftermath. But the problem is that today, in the aftermath of the crisis, inequality has grown even more. And that, of course, has dampened demand even more. And in the United States, the particular way we've organized ourselves has made things worse. Just to give you, the contrast between Canada and the United States in one particular thing, just to illustrate it, we have we require students to pay a very large fraction of the cost of education, and since 2008, we've required them to pay more and more of their school. But I remember, and the result of that is that tuition has been soaring all over the United States, in the private schools, but also in the state schools. And any of you who have children going to the United States know what I'm talking about. But if you remember that graph I showed, median income is going down or stagnant. So you have a problem. How are you going to give education for all, or for everybody who is qualified, if incomes are going down and tuition is going up? There's only one way you square that circle, and that's debt. And student debt now in the United States is over $1 trillion. Student debt is larger than credit card debt. But students know that it's a noose around their neck. And it is one of the factors that is dampening our economy. And there is, right now, no good solution. There are some solutions. I have some solutions. But anyway, Congress and the U.S., the states, have not been willing to address what ought to be done to remedy the situation. The fourth problem is austerity, unnecessary austerity. There are some countries like Greece that just can't spend because nobody will give them money. But we're talking about the United States now, where we can borrow at a negative real interest rate. You might say it's foolish that people would lend us money at a negative real interest rate, but whether it's foolish or not, the fact is that we can borrow at a negative real interest rate. That is to say, in real terms, we pay back less than we borrow. And because we've underinvested for a very long time in the public sector, we have lots of investment with very high returns. So if you're a business and you could borrow at a negative real interest rate, and you have investments that yield a positive real return of 15, 20, some of them, areas of technology have 30, 40, 50% returns, you would be foolish not to borrow. Your balance sheet at the end of the year would be larger. But unfortunately, because of the political gridlock in the United States, we aren't doing that. We're cutting back. And while we haven't made as big a deal of austerity as Europe has, the fact is America has experienced austerity. There are about 500,000 fewer public sector employees today than we had before the crisis. And if we had a normal expansion in line with the growth of our economy, with our population, we would have about about 2 million more workers in the public sector. So the shortfall as a result of this austerity is about 2.5 million. And obviously that's a major dampener on our economy. And obviously from a global point of view, what is going on in Europe is an order of magnitude worse. The final thing is a financial sector that's not doing what it should. In fact, in many ways, particularly in Europe, you see public sector austerity being combined with, you might call private sector austerity, because the financial sector is actually reducing the amount of loans, especially to small and medium-sized enterprises. You have a contraction in the public sector, but you also have a contraction in the private sector. And I mentioned in the United States that the decline in SME lending is about 20%. In Europe, it's much, much larger in the crisis countries. So this goes back to the theme I mentioned earlier. If we could have recycled the surpluses that exist in the surplus countries and used it for investments, productive investments, the surpluses would not have been a problem. But our financial system hasn't been able to do that. There are parts of our financial system that have worked very well. You know, in the United States particularly, the venture capital sector has provided the funds for the new enterprises. But you have to understand this is a very, very small fraction of our overall financial system. Well, I want to leave time for some questions. So let me just very quickly end with a couple questions about the U.S. and then open it up for you to ask me some questions. So one of the puzzles, somewhat puzzles, is while after the crisis, the U.S. savings rates increased. U.S. savings rate had been 0. Again, not a very good, healthy number for the long term. It then increased, but it started to decrease again. And the question is why? Part of the answer to that is that the stock market, increasing stock market prices. One of the factors in the increasing stock market prices was the low interest rates, quantitative easing, low interest rates of the Fed. There's a curious policy of the Fed in which the Fed tried to engineer a recovery by making the rich in the United States even richer, by creating a stock market bubble, or no, I won't say a bubble, an increase in the stock market price. The increase, the magnitude of the increase of wealth is not surprisingly translated into increased consumption, not as strong as they had hoped, but still some increase in consumption. But what the country needs is not more consumption, but actually more investment. And private investment is still lower than its pre-recession level. Well, one of the questions that people are asking is, will the real estate sector recover? The overhang is largely worked off, but with the income of most Americans stagnating, overall demand is stagnating. And with youth unemployment so high, prospects so low, wealth so low, household formation has been weakened. Real major change in living patterns going on in the United States. More and more children are living with their parents. And when I say children, people are in the 20s and early 30s. This is a very, parents wanted to see more of their children, but not this much more. And so this is really not because of a sudden increase in the lovingness between parents and their children, but because economics does affect how family formation. Well, as we think about policy going forward, it should be clear that monetary policy is not going to get us out of this crisis. Monetary policy basically has reached the limits. It was clear back in 2009 that that was the case. What the world needs, I think, is a fiscal stimulus, but unfortunately, the politics, both in Europe and the United States, makes that very, very difficult. So the result of all this is, as I look forward to the overall outlook, it remains dismal unless there are major changes in policy, which I don't see coming. And in a sense, from an economic point of view, I think we do know what needs to be done to get the economies back on track. Just to give you one example, if you listen to the rhetoric of Abe in Japan, I think he has the right overall framework, although the way he's executed is not so right. He's talked about you need monetary stimulus, but also fiscal stimulus and structural reforms, a growth strategy. He talked, repeatedly about needing all three arrows working together. And the United States and Europe have been focusing on just basically one arrow, namely monetary policy, and that just it won't do the trick. But the problem is the prospects of political support for such policies remain bleak. And so the likely outcome is that the United States and Europe will face a long-term, what might be called Japanese-style malaise. Europe will be worse than the United States, but in Japan, even in the midst of their Japanese-style malaise, unemployment was only about 5%. And so there was a strong sense of, you might say, a social protection provided by that low unemployment. And if you look at Japanese growth adjusted for the labor force, remember that the Japanese labor force was declining at the rate of 0.75% a year, Japan's economic performance, even in the malaise, was better than in most of the other advanced countries. So when you say you're talking about a Japanese-style malaise for Europe and America, I think just to end on an even more dismal note, it will be much worse than what happened in Japan.